More oil does not mean more revenue for the state of Alaska. Despite the massive oil developments underway right now, like ConocoPhillips, Willow, and Santos Pikka projects, the Department of Revenue's latest 25-year analysis shows us an ugly truth. Alaska's production tax revenues will continue declining. Both projects, once billed as major fiscal wins, barely move the needle when it comes to stabilizing the state's unrestricted general fund, the UGF income. And with an increasing share of oil coming from federal lands, where the state doesn't collect a dime in royalties, Alaska's already fragile fiscal outlook just ends up getting worse. Alaska gets almost nothing from Willow's early years and barely more from Pikka. Even though these two projects represent almost half of Alaska's oil production by 2034, these two mega projects contribute less than 25% of the already depressed production tax base. Even at peak output, Alaska's revenue share shrinks. Inflation-adjusted state returns get worse, not better, and producer profits rise substantially. In short, the oil flows, but the money doesn't. That's because Alaska's production tax system doesn't scale with new oil developments, especially federal ones like Willow, which have zero state royalties. Production tax policy favors front-loaded deductions and credits, so it delays any meaningful revenue until most of the oil's already gone. Alaska's UGF dependence on oil is increasingly unstable, and this shatters the myth that more barrels equal more revenue. The DOR's Willow and Pikka deep dive is a loud alarm for policymakers. Alaska's current oil tax system is structurally incapable of sustaining long-term state revenues. Instead of closing budget gaps, these mega projects are ushering in a new era of fiscal shortfalls, even as oil production technically rises. If the system isn't changed, the state's share of its own resources will continue to decline, and so will Alaska's ability to fund even our most basic services, our education, and our infrastructure.